Municipal waste handling is a vast market, and most municipal corporations have shifted to this new model of handling waste now, which is considered to be much more efficient, is cost effective, is transparent, and is technology driven. Antony Waste Handling Cells IPO has opened for subscription, and it is one of the leading national players in this space with an extensive experience and expertise backed by technology and also research. We'll discuss today in this edition whether investors should subscribe to this one. Now, the company enters into multi-year contracts with municipalities handling solid waste of the local municipalities, also providing end-to-end waste handling solution on a daily tonnage basis. Now, with about 19 years of experience, the company has carved out a niche in this dynamic and delicate market. It is currently operating in 18 sites including Mumbai, Delhi, Thane, Noida, Nagpur, with 2 solid waste processing units as well. Now, the other notable thing about the company is that today the clients and municipalities are looking for complete solution in terms of managing disposal of the waste, the handling, the equipment and fleets, and managing labor as well. Now, the company is not only able to completely manage all of these concerns together, but has also offerings such as RFID based tracking and systems. In the current environment, also with a focus on quality, customers are no longer looking for the lowest bidder. Antony emerges as a viable option here, as it is the largest waste processing unit in India and brings a huge advantage in terms of offering the best solutions. Now, secondly, it is estimated that for every rupee of the incremental revenue, the company needs to invest close to about 1.2 to 1.3 rupees for the capex. Now, thus the company, also as the company really scales up its operations, the balance sheet needs to be funded in absence of enough internal resources as well. Thankfully, it has been quite conservative in its approach and has used its financial leverage quite prudently in the past. The company has kept a strong control over the working capital and net debt to equity as well, which has historically been at around 0.5 to 0.7 times. Now, interestingly, at around 25% of the return on equity and the current scale of operations, the business has been generating good cash flows, which in itself should be good enough to propel growth, and we thus rule out all the possibilities of increase in financial leverage and also significant equity dilution in the future as well. Now, at the upper end of the IPO price at say 315 rupees, the issue is valued at 14 times its fiscal 2020 earnings. Now, even on a conservative basis, if we average profits of say last 4 fiscals, it reasonably is valued at 20 times earnings, considering the dominant position in the growing industry. Moreover, its superior return ratios and also the prudent balance sheet management and strong margins also support valuation going forward. So, investors looking to get a pie in this kind of a market can definitely look to subscribe to this IPO for the long term.